it also means is that we can expect, I think, a good deal of inflation, which should do very well for all commodities and will probably do well for stocks and cryptos too. Probably will. But in terms of measuring it in ounces of gold, my belief is that all of these things will fall in terms of its relation to an ounce of gold. And the rest of the world is done taking our treasuries. The appetite for our treasuries is completely and totally gone. And maybe you bring in a Judy Shelton to one of the Fed governor positions who has enough pull to actually introduce legislation to do the 30-year treasury redeemable in gold, as she speaks of, to give some form of incentive to hold our debt where you have to be out of your mind to buy a 10-year treasury right now. To me, it's uninvestable.
In today's news recap, higher supplies to the UK lift Swiss. October gold exports. Gold exports from Switzerland rose in October compared to September due to higher supplies to Britain, but were down from a year ago as high gold prices kept deliveries to China and Hong Kong subdued. Swiss customs data showed on Tuesday supplies from Switzerland, the world's biggest bullion refining and transit hub to Britain in October, reached the highest level since June 2021, according to the data. London is the world's largest center for over-the-counter trading of gold. This year's 27% gold price rally, which took spot prices to a record high of $2,790.15 per troy ounce on October 31st, has been affecting physical demand in China, the world's top consumer of the metal. However, gold exports from Switzerland to India, the world's second largest gold consumer and a major importer, rose in October from September amid festival purchases. Before we jump back into the clips, check out our exclusive Black Friday VPN deal. A good VPN is essential for keeping your data private and secure. And with this deal, you're getting top-tier protection for just a few bucks. It's fast, reliable, and a no-brainer at this price. Plus, you'll get 3 extra months free and a 30-day money-back guarantee. Check the link in the pinned com. Don't miss out.
And they use these opportunities where the paper price is smashed down to buy and to take possession and take delivery of. And I think it speaks to the real demand for gold and silver. And we're not even talking physical in retail. We're talking on a much broader basis. The biggest money in the world understands that, I think, that this is a transition period away from things like US Treasuries, which again are getting eviscerated as the 10-year goes higher, which has been weaponized, which has risen by 500 basis points in a year, which is succumbing to inflation. And because of the weaponization and because of this inflation and ultimately, I guess it's a long shot, but you could even say default risk. And what we did with Russian treasuries is default. I mean, call it what you want, call it sanctioning. It's stealing. We defaulted and we used it to fund the Ukrainian war. And these are things, they're doing the same thing in the European Union. These are very provocative moves. And so the rest of the world is saying, I don't want to hold treasuries anymore and I'll buy commodities with it. But they're very shrewd in the way that they do it. They don't buy it the way most people think they should. Just buy it all. Well, then the whole thing blows apart. Instead, they're doing it far more methodical, far more diabolical. They're playing the long game. And every time we're stupid enough to knock it down, they're there with dollars that are losing value and treasuries which are rolling off their balance sheet and using the proceeds to buy things like gold and silver, and boom, it comes right back up again. So it's not going to be straight line, but what we see with Trump is something we should be excited about. We should be happy that they're going to address all of the things that they are addressing, but it doesn't change the fact that one way or the other, whether it's orderly, where Trump were to do all of these things, bring back manufacturing, in order to do that, in order to do the things that he's talking about, we don't have a manufacturing base. We don't have the facilities or the machinery. You'd have to build all that. That takes time. You'd have to train people. All of the things that he wants to do to become more of a protectionist country, if you will, America first. Well, that could send us into a Great Depression. Or maybe it's far worse than that, and he presides over some form of a reset. Any way you look at it, to get to the other side, and I'm optimistic. I really am. I'm optimistic for the future of the country, more so than I have been for the last 4 years, But that doesn't mean that we don't have to go through some event, whether it be orderly, which probably not, or somewhat chaotic, whether it be a depression or a hyperinflation or a combination of the both, where it's hyperstagflation, where the Great Depression 2.0 meets the printing press. One way or the other, you have to pay your bar tab. And I think that's coming, and I think the world understands that, and they'll choose inflation over the very, very difficult decisions unless they're willing to slash military, slash Social Security, slash Medicare, slash pensions, slash military or veteran benefits. They're not going to do that. And if that be the case, then it will only increase the amount of debt that is accumulating day by day by day to the tune of $3 billion a day increase. And even slashing all of the waste, the interest just on the accumulated debt is moving at such a pace that it will overwhelm by 2031 everything. It will be the largest line item across the board, only allowing them to make Medicare and Social Security payments, and everything else, all discretional items will have to be borrowed. And of course, that probably means higher taxes as well. So there will be pain to deal with. What that looks like, I don't know. And we'll get through to the other side. But what it also means is that we can expect, I think, a good deal of inflation, which should do very well for all commodities, and will probably do well for stocks and cryptos too. Probably will. But in terms of measuring it in ounces of gold, my belief is that all of these things will fall in terms of its relation to an ounce of gold. And the rest of the world is done taking our treasuries. The appetite for our treasuries is completely and totally gone. And maybe you bring in a Judy Shelton to one of the Fed governor positions who has enough pull to actually introduce legislation to do the 30-year treasury redeemable in gold, as she speaks of, to give some form of incentive to hold our debt where you have to be out of your mind to buy a 10-year treasury. Right now, to me, it's uninvestable. Inflation being so much higher and there's so much risk in holding it, at some point, these kinds of things will need to be addressed. And when you have the level of indebtedness, we have the needing at least 10 trillion a year to finance debt that's rolling over and new debt. Who's going to buy all of those treasuries? Does it mean that ultimately it's the Federal Reserve, which is monetization, which creates hyperinflation? I mean, any way you cut it, we have to go through that period of darkness, of pain, of paying our bar tab. And I think there's no one better to administer that than Trump. But to think that the reasoning for holding commodities just vanished is a big mistake. And that's what the traders used to clean up a bunch of their short positions that were really butchering their balance sheet.
In today's news recap, India's Gold 817 market update festive buying holds ground in the face of high prices. Gold extended its record-breaking streak into October. Momentum softens. Post-U.S. elections, gold continued its rally in October for the fourth consecutive month, hitting multiple fresh highs and closing the month with a gain of almost 5% at $2,779 per ounce. The price rise was driven by event risk and uncertainty surrounding the U.S. elections, along with escalating geopolitical tensions, which outweighed the higher opportunity cost for gold on account of a stronger U.S. dollar and higher bond yield. The rally in gold paused post the U.S. election as the dollar strengthened and Treasury yields rose. In fact, both international and domestic gold prices have fallen by 8% since the end of October. Despite this recent pullback, gold remains one of the best-performing assets this year, with a YTD return of 177% in Indian rupee terms at the time of publication. Gold in the domestic market has been trading at a slight discount to its international counterpart since mid-August, reflecting a balanced demand-940 supply dynamic. Following the sharp import duty cut in July, the flow of smuggled gold into the country has almost ceased, making way for official imports despite record-high prices. Consumer buying during Diwali was strong in both gold jewelry and bars, and coins markets and media reported higher footfall at jewelry stores and robust buying of coins via online as well as offline platforms, promotional events and marketing campaigns undertaken by jewelers to lift sales. Indian gold ETFs continued to attract strong inflows in 10-20 October, fueled by a favorable gold price momentum and increased volatility in domestic stock markets. The long-term capital gains treatment for gold, which was announced in July, has provided a continued boost, as reflected in the significant rise in inflows since that time.